Nike Inc. (NKE) is a great company that has successfully grown over the years to be the leader in sportswear apparel and footwear for both men and women. The company has grown fast and efficiently due to a strong focus on quality and innovation that has outpaced competitors for years. Recently, however, Adidas OTCQX:ADDYY, the German sportswear giant, has been growing traction in the global footwear and apparel marketplace, becoming a threat to Nike. Nike is an excellent company, yet a poor choice for an investment currently, and here is why. Currently Nike is trading at roughly 23.5x their LTM earnings. The 5-year average for P/E shows that this is a reasonable price to get into the stock. This, however, is inflated, I believe, because of a one-off tax benefit that led to favorable EPS growth, while hiding struggling internal conditions and the struggling external environment. The adjusted EPS should be around $2.39, which would mean the company is currently trading at 24.7x earnings. This is in the high spectrum for TTM P/E multiples that the company has had in the past 3 years. In terms of price to book, the company is again trading at a very high level, making this a poor entry time for the stock. Current price to book is 7.31x, matching the 5-year normalized P/B multiples. Valuation is inherently poor in nature due to the lack of analysis that justifies the future price estimation for the stock. Yet it is worth noting for use as a quick measure to justify an entry price, even if fundamental analysis doesn't match the multiple valuation. Midsummer this past year, Nike released a new growth plan to provide customers with unmatched personalization at large scale. The plan is labeled the Consumer Direct Offense and will be implemented and developed in the next few years. The plan includes the triple-double strategy to provide double the innovation, double the speed and double the direct connections with consumers. The idea of the platform is to innovate products that are already staples of the business, reducing the total amount of styles offered by 25%, bringing them to the market in half the time. This will likely help reduce accumulating inventory due to changing trends and products going out of style. The 2x direct strategy is the most interesting, as it is Nike's way of creating a personalized experience for every customer, building the essential feeling of the brand in everyday life. Also, the use of mobile applications to support the plan creates a membership feel to Nike and offer direct personalized marketing by style, geography, and flash updates. While the strategy is highly detailed in combating the changing market conditions, its success is yet to be proven, with current future orders down 2% in November. It's arguably too early to tell if the strategy will have a long-term effectiveness as desired. The strategy also doesn't clearly outline any margin expansion, which will be touched upon the next. Nike operates with the best margins in the industry, which is a staple of the strength of the stock. All other competitors operate around 200-500 basis points lower in terms of EBITDA margins, with Adidas, the main competitor, with a trailing EBITDA margin that is 413 basis points lower. Although Nike is significantly higher, the only way for continued value creation is to expand margins, which just cannot be justified. The consumer direct offense strategy that Nike is currently pursuing calls for this further margin expansion, but anything that surpasses the historical fluctuation of roughly 2% is too aggressive in being used for models. It is likely that the strategy could have a potentially favorable impact on SG. Again, is the strategy enough to place Nike in a better place financially? It is too soon to tell. Lastly, a quick industry analysis. The global retail industry is in different stages based on economic development and cultural affluences. In the North American region, there is a significant shock in the retail market leading to store closures and bankruptcies. With the shrinking retail industry domestically and demand not being recaptured through e-commerce currently, estimates suggest mature levels of growth in the footwear and sports apparel industry. In Europe, the market for athletic apparel and footwear is also nearing a mature phase with a CAGR of roughly 5% through 2021, Statista. The two main geographic areas for this industry moving forward include the Greater Asian markets. China has been growing at 4 times the rate of the US economy, and the footwear and athletic apparel industry has been experiencing very high growth above that. Based on corporate reporting from competitors, the Chinese market has been experiencing revenue growth between 20–30%. China and Japan are the fastest growing markets, yet combined only account for 15.3% of Nike's LTM revenue. This is a potential area for increased investment to spike revenue growth. However, recent political instability between the US and North Korea acts against the continuation of growth in these two highly anticipated areas. Nike fails to give any headwind into a shift in geographic investment as well. Based on multiples, the company is priced too high to justify entering a position currently. The company is well set to be a growth stock that will likely match industry mature levels of growth based on a worst-case basis. Based on success of the growth initiative, Nike may see roughly 10% growth in revenue and a better bottom line from increased margins. I believe this is overly optimistic on the projections, and faith in the new demand creation initiative is too high. Also, these projections are currently reflected in the high stock price. Currently, the justification for entering a position in Nike is not there at the current share price, as the downside potential highly outweighs the likelihood of outperforming already aggressive guidance. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.